59,500, 59,750 zones.
Arpit, we'll pause you there. Let's go across. Seshadri Sen joining us. Seshadri, let me try and get your take. So 29,000 on the Nifty is what you're building it on. Talk to us about what the FY26 and FY27 earnings is going to look like according to you, that you're penciling in a 29K on the Nifty. What are you expecting in terms of valuations, and are you expecting a possibility of earning surprise to the estimates that you've already built in, is what I'm trying to get to.
Yeah, thanks for hosting me. So 29,000, to clarify, is a December 26 target. It's 12 months away, which implies about a low single digit, around an 11% return on the Nifty in CY26, similar to what the Nifty delivered in CY25. We are penciling in about 7 to 8% earnings growth for FY26. There have been some idiosyncrasies because of composition changes there. But FY27 should be a 30 to 40% EPS growth. We are quite constructive on the broader economy, especially on the consumption side. We think that the multiple stimuli that have come through both from the RBI and then the government in the form of GST cuts. We had income tax cuts earlier this year as well. And at some stage in the next year, you'll have the pay commission. So if you accumulate all of that, plus there's been a lot of deregulation in many sectors, the main one in the financial services and lending space. So all of that will combine to cause a significant acceleration in consumption and the overall economic cycle. We are also expecting credit growth to pick up from, it's already moved from 9 to 11.5, and we're expecting a further movement to 13.3% in FY27. So all in all, we think FY27 there should be significant growth momentum, translating to a 13 to 14% Nifty EPS growth, and that's what we're basing our December 26 Nifty target on.
Fair point. Seshadri, how do you view the larger caps versus the mid and the small? Do you expect outperformance on the broader end of the spectrum? Because and how will earnings behave on both sides? Give us a sense of that as well.
From a one-year perspective, we continue to prefer small and mid caps. What we are saying is that the larger caps give you some insurance against market volatility. And in the short term, we do expect something on some volatility and some, sharp movement, bi-directional movement in the Nifty. But for alpha generation, for outperformance, we think small and mid cap is the place to be. That is where you're getting better growth. Not only are there some of the higher growing sectors which are exclusively small and mid cap, with very little large cap presence there. Even within some of the sectors like BFSI, IT, the smaller caps are delivering better earnings growth than the larger caps. So as the market gets into growth mode, we think the small and mid cap will deliver better performance than the larger caps. But it will be a volatile year, especially as we start the year. We expect quite a bit of volatility, and to protect against that, a bit of large caps in the portfolio should help.
So interesting that you say that, Seshadri, because everyone that we've been speaking with, the consensus seems to be that, it's not going to be the year of small caps and mid caps for sure, but large caps, like you also said, are the safer lot. But other than that, the problem with small and mid caps, and please correct me if I'm wrong here, is also about the froth pockets, right? I mean, you debate about what is it that you do with EMS, defense, all those kind of sectors wherein perhaps they've already had their heydays in the sun. Where is it that you feel that there is still exuberance or overvaluation within small and mid caps, and one needs to steer clear of those sectors?
It's a little more complicated than that. It's not whole sectors which are overvalued. There are specific companies in every sector which are overvalued. If you look at capital goods, it's a very large segment. It's very dominated by small and mid caps. There are, admittedly, very absurdly valued pockets, and it will be tough to get outperformance if you buy something in ATP, however good that stock is. But within each sector, you will find stocks that are not so egregiously valued, And some of which the valuations are supported by really supernormal growth over the next 2-3 years. So when you look at the growth adjusted valuations 2 to 3 years out, the current optically high Ps may not look so absurd. So definitely, within IT and BFSI are two areas where I think small and mid caps will offer much better opportunity than the large cap space. And within the so-called more expensive sectors, some of which you just alluded to, if you look hard enough, there will be some stocks which are in takeoff stage on growth. Valuation may look optically high, but if you really do your work and figure out the growth momentum, I think there is a lot of money to be made there as well. So, going back to your original comment on buying contrarian, I don't treat small and mid cap space as a monolith. The moment you start doing that, then it stops making sense. But it's a huge segment. If you take the whole market, remove the top 150 stocks, that's your small and mid cap space. There is plenty of opportunities there to make money. And I repeat, if you want to generate outperformance, that's where you should look. The large caps will offer very limited outperformance from here on.
And within mid and small caps, Seshadri, you believe it's going to be IT and BFSI?
Those are two examples that I gave. I think you should need to look at consumer discretionary is one space that in terms of our sectoral approach, we are actually underweight on IT and BFSI because we don't like the large caps there. And consumer discretionary is one space where we are particularly excited. It's a very large space, admittedly. If you want to slice and dice in auto and auto anchors there, will provide you a lot of opportunities. The internet space is something that we are very excited about. And almost every month there are newer stocks getting added to that space. And I think that's a really long-term growth space where you have to look through the near-term optical losses, etc. And if you pick the winners, I think they can show hyper growth for half a decade at least, if not longer. And once you account for that, then the valuations don't look so determined.
Seshadri, so within consumer discretionary, you spoke about auto as being one of them. Do you believe that some of the re-rating has already happened, or are you anticipating, and is it going to be bottom-up stories which you need to pick within this basket? Or is it going to be pretty much the whole auto pack which is going to benefit from the tailwind of the GST rate cut and and of the policies with regard to reducing rates as well?
Bottom up. Certainly, I think you need to go bottom up in that sector. The first wave of GST benefits has come through. I'm not in the camp which says that this is a one quarter and done kind of phenomenon. The GST cuts will have a much more longer lasting effect on aggregate demand in the auto space. But however, from here on, obviously growth will moderate a little bit. And in that segment, you will have to pick out the winners, right? The companies that have the newer model, the company that have stronger brands, stronger distribution, which will outlast some. So, the phase of rising tide lifting all boats has gone. You will have to be selective from here on. Likewise with auto ancillaries. I think a lot of auto ancillaries have been sort of left out of this argument, but they also are slipstream beneficiaries of the resumption of the auto cycle. Or you'll also have to look at categories. We prefer passenger vehicles and two-wheelers over CVs and tractors, though there are signs of a turnaround in CVs at least. So you'll have to, divide it vertically and also look at individual companies, market positions, etc., the ability to sustain continued product and brand launches for them to be able to capitalize on what we think will be a relatively high growth year in CY26.
Okay. And on the consumer discretionary side, otherwise, Seshadri, outside of auto, you also like maybe air conditioners, maybe that sector, that space seems to be attracting your eye. Talk to us about rural versus urban. Is there going to be an outperformance in any one of these, or is it going to be pretty much across the board?
See, I don't like the rural-urban. I think the rural-urban divide is a bit artificial. I prefer to talk about premium and mass. At the moment, I would focus on premium. Longer term, I think mass. The mass segments had a bad time after COVID. About 3 years, mass segment struggled. I think from the earlier part of this year, partly because of the cash transfers in multiple states, partly because I think generally household balance sheets in poorer, in the lower income segments have largely been repaired. You are seeing some momentum. There is some worries about low inflation impacting crop prices and that impact, but that would be strictly short term. So the final answer to the question is that both premium and mass should do well. Both urban and rural should do well. So this would be a fairly broad-based consumption revival. I don't think it will be a narrow revival like we saw in the immediate post-COVID phase.
That really throws up so many more questions. Seshadri, we have to take a commercial break, but if I can just request you to stay with us, we'll come back and we'll continue our discussion with you.
For detail. The hot cover. Because this why on the ground. now. Get up for detail.
Back with closing trades right here on ET Now. We're still in conversation with Seshadri Sen, Head of Research and Strategist at Emkay Global Financial Services. Seshadri, thanks for waiting by. I was just observing your thoughts on the entire consumption pack. And, clearly the government also seems to be aligned with that, given all the strategic moves that we've seen in the last 1 year or so. But tell me, what happens with the upcoming budget? Do you think there will be a further fillip or thrust to consumption? And would that then come at the cost of perhaps a capex slowdown?
No, I don't think there will be any further specific stimuli except for the provision that will have to be made for the wage pay commission that is coming up in the next financial year. Beyond that, the space for the government to be able to provide further stimuli is somewhat limited. I don't think that there will be any serious let-up in the government capex plans. The central government remains the most major player in the overall country's capex profile. Corporate India is unable to pick up that slack, so I don't think there will be any in contemplation of slowing down. We expect state central government capex to grow largely in line with GDP, maybe 1 or 2 percentage points higher, in fact. Given what's happening in the bond markets, the scope for overshoot on the fiscal deficit is also fairly limited. Not really penciling in a further consumption boost in the budget that is coming up in a couple of months. It will be sort of a steady as you go budget, following a path of continuation of existing policies rather than trying something dramatically new.
What about monetary easing, though? Do you sense that we could see further easing by the central bank through 2026?
Yes, I think that there will be some further easing. The commentary around the last cut seemed to indicate that there will be further easing. But I'm looking at easing on 3 fronts. Rate cuts is a small part of that, and we may see another rate cut if inflation continues along the trajectory that it is. And we do think that upside risks to inflation are fairly limited at this point in time. The second is liquidity, where I think the intent of the RBI is to keep the system liquidity at a reasonably healthy level, at least about 1%. The challenge they are facing on that front is that the pressures on the external account and the currency is pushing liquidity down in sporadic, especially when it needs to intervene to protect the rupee. So that is an equation which the RBI will manage, but there will be sporadic bouts where that liquidity is not available, and transmission will slow down to a little because of that. The third part is lending deregulation, where a lot has been done. Very frankly, the last 9 to 10 months, there's been very aggressive lending deregulation. You probably can expect a little more of that. One of the interesting things that has happened is that, foreign direct investment into banks. We've seen 2 foreign banks and 2 large PE funds being allowed to take significant stakes in some of the local banks. So that kind of reform, I think, will be pushed forward so as to expand the overall financial services industry. So you will see monetary easing, but some of it will be conventional, some of it will be non-conventional.
Chaudhary, you're underweight financials and especially the large cap financials. It's surprising here because you've got 4 out of the top 5 private sector banks trading at below and well below their 5-year price to book valuations. And even the PSU banks are not trading at materially expensive valuations, despite it being a very, very good asset quality cycle that we're currently seeing with growth likely to come back. Give us the rationale as to why you feel the larger ones won't do well. I know the mid and the small you're bullish on, so that point being made. But what of the larger ones?
It's a position I've held for the last 2.5 years, and I continue to maintain that. I think the historical ranges of valuations of private banks are irrelevant at this point in time because their growth rates are in a completely different zone. They used to grow in the 20 to 25% region when they were trading at four times price to book. Now that growth in a best case scenario is 15%. There is a big difference in the valuations of banks when the growth falls below ROE and they stop consuming capital. So in a best case scenario, we don't see them reaching that limit. Most banks will grow in the 12 to 15% range. And for that, a 2+ time price to book is difficult to sustain over time. That is the long-term view we have on large private sector banks, which is why we are underweight. We are very biased towards high growth. We prefer paying higher multiples for higher growth than trying to look for value in low growth stocks, especially when there's a theoretical mismatch in terms of valuation versus growth. So we think if you take a 3-year view, banks will further derate, even though 2.1 to 2.3 may look optically cheap compared to where they used to trade. But given their growth versus what used to be there, that's still not cheap enough.
Seshadri, so good having you on the show today. Thank you for your time.
Thank you so much for hosting me. Always a pleasure.
Okay, let me now welcome on board